In the first week of January 2025, the United States Treasury Department announced that foreign holdings of US debt had fallen to their lowest level in 3 years. At the same time, Australia's residential property market saw its largest quarterly surge in foreign investment since 2017. These two events are not unrelated. What we are witnessing is the early stage of a capital reallocation that could fundamentally alter Australia's economic landscape over the next 18 months. If you hold Australian superannuation, own property, or depend on a stable currency, this matters to you directly. A wave of international capital seeking stability doesn't simply raise home prices. It reshapes interest rates, employment markets, currency strength, and the fiscal decisions your government will make in 2025 and 2026. It also raises a strategic question. Does Australia have the infrastructure, policy framework, and political will to absorb this capital wisely, or will it destabilize what we've built? In this video, we'll examine 3 things. First, how America's fiscal position deteriorated to the point where confidence is eroding. Second, why Australia is emerging as a preferred destination for capital flight, and what the data reveals. And finally, what this means for Australians in practical terms, your savings, your property market, and your country's sovereignty. Let's begin. To understand today's situation, we need to briefly go back to 2008. The global financial crisis marked a turning point in how Western economies managed debt. The United States, in particular, adopted a policy of aggressive monetary expansion, quantitative easing, to stabilize its banking system. This worked in the short term, but it created a dependency. Between 2008 and 2024, the US national debt tripled from $10 trillion to $34 trillion. That's not inherently catastrophic. Japan has carried higher debt-to-GDP ratios for decades. The difference is this: the United States relies on the willingness of foreign governments and investors to continue purchasing that debt. When confidence in that system weakens, the entire structure becomes fragile. We saw the first cracks in 2023. China reduced its holdings of US treasuries by nearly 20%. Japan, historically the largest foreign holder, began quietly diversifying into European and emerging market bonds. By late 2024, several Gulf states signaled they were exploring alternatives to dollar-denominated reserves. These are not panic moves. They are strategic adjustments. But when the world's largest creditors adjust, the debtor must respond, and the United States has very few good options. Now let's turn to the numbers as they stand today. I want you to look closely at this. In the fourth quarter of 2024, the US federal government spent more on debt servicing than on its entire defense budget. That is not a sustainable trajectory. At the same time, inflation remains structurally embedded in the American economy. Not the temporary inflation of supply chain disruptions, but the inflation that comes from decades of currency creation without corresponding productivity growth. The Federal Reserve is trapped. If it raises rates further, it risks triggering a wave of corporate bankruptcies and a recession. If it lowers rates, it fuels inflation and weakens the dollar's global standing. Neither option restores confidence. What's unusual here is the behavior of institutional investors. Pension funds, sovereign wealth managers, and family offices are not waiting for a crisis to unfold. They are moving capital now, preemptively, into jurisdictions they perceive as stable. Australia is high on that list. Why? 3 reasons: political stability, resource wealth, and geographic insulation from the immediate theater of US-China competition. Let me be specific. In the 12 months ending December 2024, foreign direct investment into Australian real estate rose by 41%. Commercial property in Sydney and Melbourne saw the largest inflows, followed by agricultural land acquisitions in Queensland and Western Australia. This is not speculative retail investment. This is institutional capital seeking preservation, not yield. Let's walk through the scenario step by step. If the United States experiences a fiscal crisis, whether through a debt downgrade, a treasury market disruption, or a sharp devaluation of the dollar, what happens next? First, Global capital seeks alternatives. The traditional safe havens are limited. Swiss banks, Singaporean property, and German bonds can only absorb so much. Australia offers something unique: a stable democracy, enforceable property rights, and vast natural resources that retain intrinsic value regardless of currency fluctuations. That makes it attractive not just to Asian capital, but to American and European wealth as well. Second, the Australian dollar strengthens significantly. A stronger currency sounds positive, but it creates problems. Australian exports become less competitive. Mining revenues decline in real terms. Manufacturing, already weak, becomes unviable. The Reserve Bank would face pressure to intervene, but doing so requires either currency devaluation tactics or accepting higher domestic inflation. Neither is pleasant. Third, property markets become distorted. If foreign capital floods into residential and commercial real estate without corresponding housing supply increases, affordability collapses further. We've seen this before, in Vancouver, in Auckland, in parts of London. The social and political consequences are severe. Young Australians priced out of home ownership, rising inequality, and political instability. Fourth, Australia's sovereignty comes under scrutiny. When foreign entities own significant portions of your infrastructure, your farmland, and your urban centres, you lose strategic autonomy. This is not xenophobia. This is basic national interest. If a crisis forces Australia to make difficult geopolitical choices, how much leverage do foreign creditors hold? This is the part most headlines miss. Capital flight isn't just an opportunity. It's a test. The question is whether Australia's government and institutions are prepared to manage it intelligently, or whether we allow short-term economic sugar highs to compromise long-term strategic positioning. Let's be clear about who benefits and who loses if this scenario unfolds. Winners. Existing Australian property owners in major cities see asset appreciation. Superannuation funds with exposure to real estate and infrastructure gain value. Legal, financial, and migration advisory services experience a boom. The Australian government collects higher tax revenues from capital inflows, at least initially. Losers. First-time homebuyers face an even more hostile market. Renters see costs rise as investment properties are held for capital gains, not rental yield. Small and medium exporters struggle with an overvalued currency. And strategically, Australia risks becoming overly dependent on foreign capital, reducing its room to maneuver in a multipolar world. The net effect depends entirely on policy. If Australia imposes strict foreign investment caps, mandates affordable housing quotas, and channels inflows into productive infrastructure rather than speculative assets, this could be managed. But if we simply allow market forces to run unchecked, the social fabric will fray. And history suggests that when middle-class wealth security is threatened, political extremism follows. So when you step back, three truths emerge. First, the United States is facing a fiscal reckoning that will erode confidence in dollar-based assets. This is not speculation. The trajectory is clear. Second, Australia will be a magnet for capital flight, not because we are exceptional, but because we are stable and resource-rich in an unstable world. Third, how we manage this inflow will determine whether it strengthens Australia or destabilizes it. The choice is ours, but the window for preparation is closing. This raises a serious question. Does massive foreign capital inflow strengthen Australia's economy, or does it compromise our long-term independence and affordability? I'd like to hear your perspective in the comments. If this concerns you, I strongly recommend watching my analysis on Australia versus China, who really controls global resources, showing on your screen at the end of this video where we go deeper into how commodity cycles shape our fiscal position. Thank you for watching.